Hey, good morning, everybody. It's Hammer. Today is Thursday, April 9th, 2026. I, of course, am Hammer, founder of Hammer Solutions, which is the home for great products such as Originator Success, helping to be found, be chosen, be remembered as an originator out there in the world. If you want to get loans from Google search, AI search, make sure you check out Originator Success. Grab and Go Social. We will help you to get out there and start getting loans from social media. We've got grab and go content as well as weekly coaching and a great community. So check us out at Grab and Go Social. Last but not least, Rate Sensei, probably the least fleshed out of the products, but our text alerts are part of that umbrella, if you will. So anyway, remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time, where we talk about what's going on in the markets with rates and pricing, what's in the headlines, what's up on the technicals. Good morning, all of my friends that are here live. If you're here this morning, say good morning. If you are watching on the replay, don't forget, give me hashtag replay in the comments. Let me know that you were here. If you would like to join me live and not miss a moment of the show, make sure you get our text reminder that I'm going live. It's absolutely free. There's no trigger leads. There's no nefarious purpose. I just send out a text as I'm going live, so you can click the link and jump on the show. So hmmr.io/reminder, hmmr.io/reminder, or use this cool QR code over here, and we will get you all dialed in. Also, if you would like a copy, each morning we send out an email, lock advice at www.raylockadvice.com. You can sign up for that or sign up for our text alerts. They're $7 a month for days like yesterday, where even though reprice risk on the day was low, it seemed like we would be okay. We did see a lot of reprices through the late afternoon as bonds did drift lower, and I'll talk about that in a minute. But you can sign up for our text alerts at www.ratetextalerts.com. All right. Well, good morning, all of my friends. Thank you for joining me. Appreciate y'all getting here. Let's go ahead and get started. We're going to jump in. We'll start out by taking a look at the technicals. Give me a minute. Let me pull up the screen and we'll look at that together. So here you are. All right. So taking a look at the technicals this morning, you will see it is not the rosy picture that we want by any means. It is the opposite of rosy. So this morning, the 5.5 coupon, we're down 20 basis points. That means we're going to definitely be seeing worse pricing than what we came out with yesterday. The 5.0, hold on, I got to click on it. Come on. Okay, let's try this. There we go. 6, 5. There it is. So notice the 5 is only down 8 basis points on the day. So we are seeing a little bit of a difference in the coupons now, a little bit more than usual. But I've been following that 5.5 coupon this week, so I'm going to stay on that one for the moment. But that one is down a little bit more significantly. So let me go ahead and click this quick recap on what happened yesterday. Bear with me. I'll pull this over. So right here, we've got our 48-hour chart. There you go. So yesterday we did our video right here, the live show right around 9:30. And that's where mortgage bonds were. You can see that we ended the day worse down here. Quite a bit worse. And it was a little bit of rocky. You can see there's basically some chatter, trading chatter, I like to call it. But overall, you can see that we did end the day lower. And that's not what we want for mortgage bonds. We want mortgage bonds to improve on the day. And a lot of that was just due to headlines about how the ceasefire was already violated, and Iran basically is frustrated that Israel is still attacking Hezbollah over in Lebanon, and they were saying that was part of the ceasefire, and everyone else was like, no, that was never part of the ceasefire. So a lot of the optimism over the ceasefire faded through the day. Unfortunate too, because I was really hoping we would pick up some momentum from that ceasefire, and there's room for rates to improve from here, but we really aren't ready to see that happen yet. So rate sheets today, in fact, are going to be worse. Let me go ahead and pull the screen back up. Bonds lost ground yesterday, as I said, when that optimism over the ceasefire ended. Let me pull up my share screen and we'll go over this. Randy said, what factors determine which coupons to follow? Reader's Digest, Barney style. All right, so I'll take a minute and answer that real quick, and then I'll go to the rest of this. So hold on a second. Let me pull this up so you know. So here's the deal, right? When we look at the coupons, generally you're going to find that you're either looking at volume. So when you look at MBS Live, Matt Graham, he'll put a little star next to the coupon that they feel is the most relevant coupon. And that is the 5.0. You'll notice that that is the 5.0. You can see it right here with this little star that he's got there. And a lot of times he's doing that for trading volume. Now, if you want to see more about trading volume, if you upgrade MBS Live to their premium package, I think you have the opportunity to see about trading volume. For me, what I'm looking at generally is I'm looking at which coupon is basically 0.75 to 1.25 on top of the coupon is what interest rate we're generally seeing on the rate sheet. So if it's a 5.5, 0.75 is 6.25. And then swinging to 1.25 would be to 6.75. So generally, that loan is going to sell into a 5.5 coupon. If it's a 5.0 coupon, the 5.0 coupon, you're generally selling a loan that's 5.75. And that can be with discount points, by the way. So 5.75 to 6.25 would be on the 5.0. I'm sorry, I wrote 6.125, but hold on to it. If I do this, I think he erases all of them. It did. Okay. So anyway, but you get the point. So, generally, like right now, we really could be watching that 5.0 coupon. The fact that there's generally not a lot of variance. So right now it's down to about 6 basis points. What you're not going to see is you're not going to see the 5.5 coupon at plus 25 basis points and the 5.0 at minus 10 basis points. You're not going to see one positive, one negative with a big gap or a big swing. And it's generally just how they're trading. Now, again, when you look at like different lock desks and what they're pricing to, the 5.0, I think Elend and Rob Pieco. Actually, I have to look and see how you say his last name. I think they look like they're pricing into that 5.0 coupon. So that's how you kind of get that, Randy. I hope that helps, my friend. Ron Siegel says he follows one closest to par, but watch the volume too. So, Ron, which one are you following right now? Which one's closest to par on a rate sheet? I don't have that. So, all right, let me get back to the other stuff while we're on here. So, rate sheets today are going to be worse. I'll pull up the screen. We'll go over it. Let's see. Pull this up here. So, yesterday, it's funny because when you look at Mortgage News Daily, if we use this as a reference point, we never really got all the way down. So, we went from 6.44 on Monday or the 7th, Tuesday, to 6.40 on Wednesday. So it did improve, but it was actually quite a bit lower from here. This is where they ended the day. A lot of reprices worse. Rates were better on the day at one point before they got here. You were back down to the 6.35. I would put it more in that range, right? So we did see quite a bit of improvement in morning rate sheets, and you're pulling back off from that. Now we're also down 20 basis points. We look at where we were when pricing came out yesterday. It's right around this 10 o'clock area, right? We were around 101.06, 101. That was a peak, so let's drop a little bit. Say 101. Let's just call it an even 101, and now we're at 100.77. So we were at 101. And now we're at 100.77. So you're talking 23 basis points, minus 23 basis points of a difference there between where we were when pricing came out yesterday and where we're at this morning. So you're going to see rate sheets that are worse. They're going to look more along the lines of that 6.45 area, like what we saw a couple of days ago. So rates are creeping up. Because of that, that puts me in a position. I mean, repurchase today is moderate. Both sides of the ceasefire are accusing each other of already violating the ceasefire, and they're kind of chipping at each other. We could see bonds drift lower through the day today. Hopefully we don't, but we could. Rates are the whole rate outlook. I'm less optimistic than we were yesterday. It looked yesterday like we could be moving into that ceasefire range of rates where things improve. And again, rates are still better than where they were March 27th. Let's take a look at kind of the worst levels here. Let me make this a little smaller so we can just get a little bit more of this on the screen. Okay. So, I mean, rate sheets right here, the 6.64, This is our worst level here. And also, if you look at optimal blue, you'll see that locks match that. So right here, the highest point, 6.494, 30-year conforming, was same thing. That was March 27th right here. This high point for where Ellos were locking. So this is optimal blue's engine. And the thing to remember here is it doesn't show any points or fees. So there could be points or fees on this, and we don't have that calculated in yet. So, but we're still looking at this. I mean, you're 6.289 versus 6.494. So we were locking in at 6.5. Now you're locking in at 6.25. Rates on average about a quarter point better than where they were. Certainly not something to shake a stick at. Not nearly as low as the end of February, where we were below, back where we were again. Loans that were locking in at 5.9, probably even a little bit lower than that. And we're up. But when you really look at the scheme of things, we're up a quarter, maybe 3/8 of a point in rate over this whole thing. So does that suck? Yes. Is that enough to derail the market? It shouldn't be. A lot of it's psychological. A lot of it is psychological. So we got to keep that in mind. Let me see what else I got on here. Lock advice for the day is lock near term and risk averse. Loans that have time have less to worry about. There's, we're likely to see rates continue to stay in this range here. There's not a lot to worry about. I don't even think that we have to worry about coming up and hitting up here. I guess the only question of that is if oil were to get a little crazy, it could be worse. Another thing to go over this morning is the PCE inflation data. So PCE inflation data came out. Remember, this is February's data. This is from the Bureau of Economic Analysis. This is the Fed's favorite gauge of inflation. The core year over year was 3.0. Slightly lower than January's rate of 3.1. So we were seeing a little bit of improvement, but again, still sticky inflation in February. It's important to note this data is before we had any of the conflict with Iran. So in theory, we're going to see that energy shock and it's going to push things higher. The core month over month of 0.4% was higher than January's rate of 0.36%. But if you round it, it's the same. Headline year over year, 2.8 was in line with January's rate of 2.8. Headline month over month, 0.4 was slightly higher than 0.28 for headline month over month. Now, as it says here, core inflation comes in as expected, doesn't include the war's impact. The Fed's preferred inflation gauge eased a touch in February, paving the way for another rate pause at the central bank's policy meeting later this month. And if we take a look at Fed futures, we do see that there is a little bit less optimism. Yesterday, after the ceasefire, we were at about a 35% expectation that we could see a rate cut. Now that's dropped to about a 25% expectation that we could see a rate cut, about a 75% expectation that rates will stay the same through the end of the year. So just the normal ebbs and flows that we're seeing here, today being one of those worst days all set up. So, but that's where we are, and that's what's going on for the day. So anyway, let's see what the rest of your comments, and then I'm going to wrap it up. Ron, you're still on the 5.5, but the 5 is pretty close to. Yeah, that's what I'm kind of vacillating between the two. Would not be surprised to see tax begin on Sunday when talks break down. Yeah, unfortunately, I think you might be right. When you mention OBMMI not showing points of fees, which is correct, how does that differ from Mortgage News Daily? It does. At Mortgage News Daily, they take a set scenario and they price it par on the rate sheet. When you look at MND, you can see what their pricing scenario is, and they're not actually including any points or fees. So the rate that Matt Graham uses is basically if you're pricing par, no loan level price adjustments, 20% down, good credit, et cetera, et cetera, et cetera. Ron, that PC is a joke. They claim they're still behind due to October government shutdown. I know that they're still on, because that's February data, not March data. We should be getting March data. So maybe they're more thorough than the BLS. That's all we can hope. But all right, my friends, well, that's it for today. I hope this gives you guys a good start on your day. Unfortunately, I wish I could give you some better news, but this is where we're at. I am here with the family. As you saw my wife walking around, we are in Virginia Beach visiting with family for a few days. So I'm going to wrap it up and go hang out with everybody else. Y'all have a fantastic day. Take care, everybody.